There's been a lot of talk about recession lately.
Recession 2023, 24.
I think there are a lot of people that think we're currently in a recession.
I'm not predicting the end of the world or an immediate recession, but the road ahead does not look great.
We've gotten warnings from top Wall Street analysts, including Deutsche Bank and Goldman Sachs. And even former Federal Reserve Chairman Ben Bernanke has expressed concerns about a recession.
The more the Fed has to tighten in order to get inflation down, the bigger the chance of a recession and the more severe it will be.
But what does it all mean? And what can we even do about it? I'm going to tell you how economists know when a recession has happened, point out some economic indicators that have done a good job of historically predicting recessions, and tell you what 3 things average Americans can do in case a recession is coming. Let's get into it.
Should Americans be prepared for a recession?
Recessions are painful. They typically involve widespread job losses, increased hunger and homelessness, and even higher death rates. So the question of whether the US economy is really headed into a recession is an important one. Officially, a recession is a significant decline in economic activity that is spread across the economy and lasts more than a few months. A US recession is determined by economists at the National Bureau for Economic Research. They look at the country's economic growth during a period of time and decide after the fact whether a recession has started and when. That means there's literally no way to know for sure that we're in a recession until after it has been declared. That said, there are some solid economic reports that have historically been reliable indicators. The first is the inversion of the US Treasury yield curve. That happened in March, and recessions are typically declared between 6 and 24 months after. Check out my video from earlier this year for more details on the yield curve and its ability to predict recessions. Big name discount retailers have also painted a gloomy picture, with Burlington, Walmart, and Ross all writing down their outlooks for this year. Another widely followed recession predictor is the Conference Board's leading economic index. The index is made up of 10 data points that include employment, housing, business orders, and markets. Put together, they have a pretty strong track record of predicting recessions. The index has been negative twice so far this year, including the most recent reading. And over the all-important 6-month period, the index is flattening out, a clear sign of an economic slowdown. Ottoman Ozil-Diram, Senior Director for Economics at the Conference Board, tells me the readings suggest we've entered a different type of economic environment and are likely at an inflection point that suggests a slowing of growth. But Ozil-Diram also notes that in terms of calling a recession, we're not there yet. The index would need to fall further, and we'd need to see economic weakness showing in more of the data. But if the worst is still to come, what can you do about it? Well, the first step is being prepared. That doesn't mean pulling everything out of your 401k and burying cash in the backyard. It means making a plan. Here's 3 simple things you can do today. First, start a savings account if you don't have one. Next, put together a budget of your monthly expenses and find places where you can save. Finally, create a spreadsheet that details how much money you would need in the event of a job loss or financial emergency, and work to put that money aside. Even if all this recession fear turns out to be hype, no one has ever regretted having a solid budget and some extra money in the bank. The situation reminds me of a plea from rapper Young Jeezy in 2008. He said, "Interest rates are going up. Seems like no value in the buck. Meat prices up to stay. Utilities are on their way. Airlines are running late. Please, let the dollar circulate." That's all for now. See you next time.